I would like to warmly welcome everyone at today's presentation about the OTC market. This is an adjusted replay of a webinar that took place on Wednesday, 21st of March, 2018. First of all, I would like to thank you for joining the stream today. I really appreciate your interest. Secondly, I would like to introduce myself. My name is Svenda and I'm the founder of the OTC Bi-Weekly, which is a newsletter exclusively focused on the over-the-counter or OTC market. The newsletter comprises of research about individual OTC stocks and a unique OTC database that helps investors to screen the space efficiently. Before we get into the content, I would like to highlight the following disclaimer. The main gist of the disclaimer is really rooted in the fact that some stocks traded on the OTC market can be slightly different to the stocks traded on the listed stock exchanges. That mainly really ties to unique risks that are present in the OTC market, some of which are going to be discussed today. These unique risks really mean that the market is not really suitable for everyone, especially not for investors that have not properly or extensively invested or traded on the listed market. I think that the listed market is some sort of a preparation for the OTC market. It also ties to research. Obviously, own due diligence is a necessity on the listed market as well. However, the way you do due diligence in the OTC market can be slightly different. What I mean by that is mainly the fact that it is imperative to understand what you own in the OTC market. When you buy an Apple stock, you probably know what product they have, what business model they're running. However, in the OTC market, sometimes the entities can be complex. They might not run the business that you actually think they're running. So it is really important to understand what you own through diligent research. Obviously, none of what I'm going to be talking about today should be considered an investment advice. It just merely reflects my opinions. And I believe that capital loss is one of the worst losses out there, so please bear Mr. Buffett's words in mind. And obviously, I may own positions in stocks mentioned in the presentation. There's going to be a financial disclosure at the end. And I'm certainly not compensated by anyone to mention or research any stocks in the presentation, or for that matter, in the newsletter. Moving to an overview of what I'm going to be talking about today, we're going to start with a quick background on myself and background on OTC markets, just to have something to put us on a solid footing that we can move the presentation forward. And obviously the main thrust of the presentation today is that the OTC market is a space with vast investment opportunities. So that is the today's thesis. And I'm going to approach that thesis as you would through an equity research perspective, which means that I will start with qualitative factors. I believe that these are mainly connected to three factors that create the opportunities in the market, while I believe that some people might perceive the factors as actually risks, but in my view, they're the factors that create the opportunity. And I'm going to support the qualitative factors with quantitative data, and that really ties to the OTC database and the results of the OTC database that I'm currently building and running. Of course, with any investment thesis, there are risks and limitations, so I'm going to talk about that after as well, especially that ties well with the disclaimer that I was just mentioning. And if you have any questions in the course of the presentation, do not hesitate to comment below, or you can send me an email, especially if you want the slides. Just email me at the contact that you see, and I'll reach back to you. Okay, so let me just quickly run through how I got interested in OTC and why I ended up creating a newsletter focused on the space. So I actually first started writing for Seeking Alpha in 2014. That was during my university time. Certainly fun experience. I was writing about uranium, other commodities, and various other different macroeconomic factors that I still believe have remote understanding of. However, it was a good segue into equity research. I then joined equity research startup based in London. So we were mainly looking at large cap European stocks. However, what I really took away is the knowledge on how to build an investment thesis and how important it is to back up the story of the stock with quantitative data. And I think that really ties well into my philosophy, because I would label myself as a deep value guy, which means that I put balance sheet first. So I operate on the premise that if a stock is trading at a premium to tangible book, it means that there are embedded expectations about future free cash flow in the company, and that really forces the analyst or investor to have a view on the underlying future free cash flows. And I'm just not very comfortable with doing that kind of forecasting. I'm not very good at it either. So I was always attracted by a balance sheet first. However, I understand the importance of operations. It's not that I would say, okay, well, whatever, it's trading at a tangible discount to tangible book. I'm a fan of. The free cash flow is important to understand, and it is important to understand how it actually relates to the balance sheet. And certainly, I have Catalyst there at the third place as well. I think that some people might want to have that on the first place or even the second place. I believe that's given by the market I'm looking at. The OTC market can be a bit specific in this. Some of the stocks do not have a clear catalyst, yet they are undervalued. And I think that sometimes the catalyst in this market is not as important as anywhere else. However, of course, it is always important to understand what the catalyst could be. So the potential catalyst for upside and downside, that's something that one needs to understand. Via this philosophy, I would really like to limit effects of macro factors. So I would like to limit my reliance on the macroeconomy and limit the reliance on the underlying future free cash flows of the company. And that's why, again, I'm balance sheet first. However, this philosophy really kind of made me become independent because if you are looking at large caps or to an extent the listed market, this philosophy might not work as well, or and therefore I returned to seeking off in the year 2016, and I started writing about opportunities on the listed market first. So I was covering nano caps and small caps, and on the listed side, your nets and other stocks that are trading below tangible book. However, I understood that while there are opportunities, and there certainly are interesting opportunities out there, the amount of opportunities is relatively limited, at least when we are in such a bull run that we are currently still. Therefore, the philosophy there was quite limited to the extent that I could use it. And at that time, I started to look at OTC, and I started to understand that my philosophy would actually work much better there. For reasons that I'm going to be discussing today. I then started the newsletter in August of 2017 as a result of going into the OTC market a bit more. And I started the newsletter mainly because I felt that there are several problems in the space which I think I can offer a solution to, or at least partial solution to. The books that I highlighted there are probably the books that kind of shape the philosophy. However, I point out that financial shenanigans is an important piece of it, and accounting is really imperative to understand. So that's where I'm really coming from. And let's dig into the basics of the OTC market. So obviously the main difference between the listed market and the OTC market, or as they are nicknamed pink sheets, is that there is no central exchange. So as you can see in my primitive illustration, the listed market is in one neat square where you can trade your Teslas and Amazons, which obviously had advantages in the past. So investors knew where to go to buy and sell stocks, and they knew that there were going to be other people buying and selling stocks. So there was a clear advantage of the central exchange. In the OTC market, this is actually decentralized. So the way it works is that the brokers actually create the market for individual stocks. So you could say that there are 17,000 individual markets in the OTC. Why 17,000 is because that's roughly the number of stocks that are quoted on the OTC market website. So how it works is that each broker has its own stocks. Not necessarily that can be connected nowadays, especially nowadays. However, it meant in past that people would have to know the broker, and they would have to know that he's making market in the stock in order to actually purchase it. So this, of course, made it harder for investors to buy and sell on the OTC market, right? You had to know the broker, and he had to make the market in your stock. However, that challenge is mostly gone. From a technical standpoint, you can trade, more than 90% of stocks through a regular broker, and that really comes down to Europe as well. So, Interactive Brokers has a normal coverage of the OTC market. And that's really because of OTC links, the alternative trading system that they operate. And so they actually connect the brokers together so that the decentralization is still there. However, you can put up a bid on any stock and get a position there through that. I mentioned that there are maybe more than 90%, but there is a percentage of stocks that you cannot trade through a regular broker. These stocks are mainly stocks that are either not publishing any public financials, or they are in a complex legal situation that might be preventing from the broker to access the stock, and so on and so forth. So sometimes it can be harder, especially for Europeans, because some of the U.S. brokers would allow trade at most OTC stocks. So sometimes that is the case. However, from my experience, I think that it's really limited amount of stocks that you cannot trade through a regular broker. So there certainly are some ways to go around that, but it's not necessary that as often as one might think. While the challenge of the access has been mainly solved via internet, the transparency and visibility is still lower than on the central exchange, and that is really tied to both investors and companies. So it is harder for investors to actually track the market, and we're going to be talking about that today as well. And it's harder to actually search for the stocks. So the visibility of the companies is not the greatest. For companies, the OTC market can be still tricky in a way of accessing investors' capital. Of course, there are avenues that you can pursue to get the capital, but it is not as straightforward as in the central exchange when you are actually trading there. There is a simple version of exchange for OTC markets, and that's otcmarkets.com, my homepage, and a page that I spend 8 hours a day on. And that's really simple in a way that it provides quotes for all the stocks out there in the OTC market. They do not provide, they do provide fundamental data for stocks that file with the SEC or file with them actually, so with the website, but they do not provide much in the way of the usual central exchange effects. And there are certain inherent limitations in what they can do, and that's mostly data driven, and they do not act as the central exchange would be. However, there are two tiers, the OTCQX and OTCQB, that are slightly different, where the OTCmarkets.com or the OTC company actually can play a substitute to the central exchange. So there are slight differences in some ways, but it's still quite limited what they can do. I believe that natural segue for many people at this point is to ask, well, why does the market even exist? I mean, I mentioned that there were some challenges in accessing the market, challenging for visibility, probably transparency. So why does it even exist? There's an important distinction that I need to make before I continue, and I believe that the distinction matters for the rest of the presentation. And the distinction is between meaningful companies and the rest. What I mean by meaningful companies are companies that have a real product, that have real revenue, and that have management team that wants to either grow the company or at least steer it in some way. And the rest of the OTC market could be comprised of shell entities, some special legal situations, but mostly it is really companies that are trading without a clear business model. I would say that the meaningful companies are actually just a fraction of the market, which again provide, that's one of the factors that I'm going to be talking about today. And maybe, the fraction could be 2,000 companies out of 17,000. That's excluding foreign stocks. And so it is a smaller part of the market. So, the stocks that I'm going to be talking about, and I'm going to talk about this slide and why do they exist. I mean, by the stocks, I mean the meaningful companies. So first and foremost, it's just an easier access to a small amount of capital. So if your business does not need 100 million, it's much easier to tap into the OTC market. It saves time. There is less regulation, which of course results in less costs. The usual way to do so would be reverse mergers. So there's not really an IPO process, however. Companies actually use the shell entities, and they input the business inside most of the time. I would also say that there is lower cost of ongoing trading on the OTC market. So to remain public, it costs much less to be on the OTC market. That is really mainly tied to regulation. So there is less regulation, less compliance cost, and so on and so forth. So there are stocks on the OTC market which have been listed on the central exchanges or on the stock exchanges, and they were perhaps too small to be to take advantage of the listing on the central exchange. So they decided, well, we're going to go OTC and we're going to save some cost. The cost can vary from 200,000, 300,000, not generally more than that. But for some companies that have, I don't know, $1 million net, in net income, this can be a material cost. They can surely spend less, especially when they deregister from the SEC. So what I mean by deregistration is that they actually are not, they're not going to be continuing to need to file public financial data with SEC. They can do so if the shareholder count of record is below 300. Of record is an important note. So the company has a shareholder list, and the brokers are named there, but the company, many of the investors the stocks are held in broker name. So essentially, that prevents some of the investors to be written on the shareholder list. So if there is really below the shareholder count below 300, they can deregister from the SEC and not file the financials with the authority. So that they can again cut costs with the compliance. I also believe that there is a third, let's say, controversial point, and I would call that a focus on business. What I mean by that is that some management teams might prefer OTC market because they simply can execute their business plan without anyone, bothering them, so to speak. There is lesser importance of guidance. 95% of the stocks or companies do not give out any kind of guidance. There's less importance of quarterly results. Wall Street is not looking at the stocks on the OTC market. And sometimes that works for sure because they can really understand the business well, and they can drive the value higher. However, as I mentioned, it is a double-edged sword because it can mean that the management teams might miscalculate the business or might miscalculate the product, and then they drive the shareholder value actually down. They dilute it, and that really is troublesome because on the OTC market there is smaller chance of activism. So if the management team is efficient, you could call that misguided activism. However, if the management team is not necessarily efficient in the way they run the business, that can be a problem. Another natural step is then to acquire, why are there valid investment opportunities? I just started the presentation, and so far I mainly talked about challenges. I highlighted the fact that there's only a fraction of meaningful businesses. I highlighted the fact that some do not file public financials with the SEC. The visibility of the market is lower, and potentially there could be some dubious incentives or that focus on business point. However, I believe that a lot of these issues or factors are actually just perceptions by other investors as risks. But in essence, they are opportunities that create the investment opportunities. So at some points might seem counterintuitive, but we're going to get to that later on in the presentation. And certainly, as I said in the beginning, the thesis of the presentation is that OTC space has valid investment opportunities, and that the database that I'm working on is helping to find these and support the argument as well. I'm going to go about this in a investment thesis approach. So I'm going to first cover the qualitative factors. I'm going to talk about some anecdotal evidence, and then I'm going to back that up with quantitative data and the OTC database results. So I believe the first factor, the most obvious factor, and probably the most notorious factor is reputation. So the reputation of the OTC market is notoriously bad. I believe that if you talk to someone connected to the finance world and you talk with him about or her about the OTC market, I think the person has two expectations. So either the person that you're talking to is expecting you to, or he's expecting him to sell you a book with the hottest penny stocks on the face of this earth, or they're expecting you to sell them the book, right? So it cuts both ways, but really the reputation is there. And a lot of times, simply put, people believe that OTC market is overly risky. Certainly, there are plentiful reasons for that. We all know who this guy is, and there are plenty of other fraudsters out there that have tarnished brand of the OTC market through executing fraudulent schemes such as pump and dumps. I would highlight, however, that the word simple. I believe that Enron type of fraud on the OTC market is highly unlikely due to the complexity of the fraud and due to the volume of the OTC market. So if you are going to run this scheme, I guess you would need something quick. You would need something simple rather than a long-term fraud that focuses on accounting. That's why also it's so notorious, because they can be quite simple in the way they work. And this reputation is really strengthened by the SEC. They acknowledge it, which is of course important. I mean, important to acknowledge that the schemes are ongoing. However, they might support the reputation more than they can, and that would mainly be through white papers that really talk about how the OTC market is full of these schemes and how investors should probably not think about investing in the OTC market in the first place. So if the watchdog is saying that, probably people will take away that reputation with them. The SEC not only points about the fraudulent schemes, but they also point towards the performance of the market. So there are quite a few academic papers that show objectively that the stocks on the OTC market underperform, and that does not mean underperformance on the listed side only. So they don't underperform the S&P 500; they actually underperform on the absolute value. So usually you should lose money when investing in OTC. But that's a point that I'm going to cover later on in the presentation. However, it really strengthens the reputation. So people would know about pump and dumps, and they would know that the performance is bad. So, this reputation really forces them to shy away. And I really want to drive this point a bit further and say that the schemes are ongoing, and that the reputation is going nowhere anytime soon. And obviously, what else should I talk about than a blockchain-related company or a cryptocurrency-related company? So Crypto Company was a reverse merger that happened in June of 2017. They changed the name, obviously. They changed the business focus, and they mentioned that they're going to work on some sort of ecosystem for crypto assets. And voila, your share price has risen 12 times. You obviously have to do a reverse stock split so that visibly the share price is higher. And actually the SEC then, after the share price inexplicably risen 12 times, they actually started looking into the stock, and they had concerns about a pump and dump scheme. So with every story that I talk about today, there's always the source below on the slide. So if you want to learn more about each story, then go there. This one's from MarketWatch that I took the source from. So the SEC acknowledged that, right? And I think that it's important to dissect the company as well, just to understand what was going on and how the reputation really gets built. So obviously, when you look at their website of the crypto company, you have the buzzwords that you need to have. Rapidly building, that's great. It has to be fast. Ecosystem, as I mentioned, and crypto assets. So you have all the buzzwords that you need to know. And these buzzwords actually value your company at $1 billion. So the shares outstanding are actually verified by transfer agent. So I'm sourcing that from otcmarkets.com. And therefore, I'm quite certain that that is the right market cap. So you have a company that is building an ecosystem of crypto assets, and then you're valued at $1 billion. Fair enough, especially when the company actually owns only $3 million in cash. So that's an interesting valuation. And I think at the height of the valuation, so when the share price actually spiked, and I think it spiked to roughly $600 per share, the company was valued at $12 billion, right? So you're trading at around price to book of 3,200, so that makes a lot of sense. So this just this just shows that companies that file with the SEC, right? So this is a SEC filing, still can undergo such activity. And I also believe that these are really not going anywhere. This was a story from December 2017, right? So quite frequent. I mean, actually, the way I found it was just to Google latest pump and dump scheme or concern, and this came up. So I think it is really important to understand that this thing is still ongoing. So the reputation of the OTC market is notorious, and unfortunately, it's not going anywhere. However, personally, I don't care too much about it. Obviously, the world will be a better place without it. However, for me, the reputation just equals opportunity. Reputation does not render every stock a pump and dump. It's clear as that. And the fact that less people will scrutinize the market because of the reputation, the more likely I will find a meaningful stock hidden in the OTC market, right? And obviously, all it ties down to is research, right? So, if you look at crypto company, just ask why. I think the most useful tool in research is just asking the question why, and that does not necessarily have to even be connected to the OTC market. That's just connected to everything. So, why a company that is valued at 12 billion actually owns only 3 million in cash? So that's an important point, I think. And I just want to highlight one of my favorite meaningless stocks to really just push the boundary a bit further again. So my favorite is a company looking for Bigfoot. So you might now think, well, okay, they probably are building an amusement park, or they want to sell souvenirs with a mythical creature. No, they were actually looking for it. And according to an SEC filing, they already own a skeleton of the creature and various DNA samples. So I believe they are the real deal. So I would just call that a definition of let's say, a meaningless stock. And obviously, you can just ask why. I would also point out that the source that I'm using here is CNBC, right? So CNBC writes about company looking for Bigfoot, and people say, well, yeah, of course, it's the OTC market. What are you expecting? So the reputation is quite powerful. However, I believe that the factor is quite understandable, and it is understandable that reputation is not everything, and therefore we could have an investor that would say, okay, well, I understand the point about reputation. I'm going to look in the market nonetheless because I know that there are schemes ongoing, but I will do the research to avoid them. However, this investor might then come to understand that the market is actually quite obscure. A lot of the situations, as I mentioned, can be complex, so that can be legal entities or royalty-bearing assets that are not necessarily tied to the underlying business, and so on and so forth, bankrupt companies, and many others that are not necessarily straightforward. And that, again, really ties to back to the Apple stock. So if you buy Apple, you know what you're buying. Here, you have to actually dig a lot more. Sometimes the business models are perhaps too straightforward. So today I'm going to highlight one company that is producing candied fruit, and that's all they do, right? And so some people might say, well, that's not really that interesting. That's actually very boring. Why should I look at that? Also, the research might be slightly different. Again, as I said, you need to look into, for example, legal entities or bankruptcy stocks. So the way you do the research can be slightly different, but I mean, again, it's just about asking the question why. So for the investor that looks into the market and says, well, okay, that's pretty obscure, he probably or she probably thinks that why would I even look at such an obscure stock, right? And instead of answering the question, they would just go away. And for me, again, that's an opportunity. Again, it's a smaller number of total people looking at the market. So, you would have a person that would say, okay, I understand the reputation, but, the stocks are too obscure for me. A good example of an obscure stock is Ethanex. So I'm very sorry for people that have been following me for a while. I am talking about Ethanex quite frequently, but I just feel that it's a nice description of the OTC market. And it is the stock that really persuaded me about potential of the market as well. So the company, Ethanex, was essentially an entity that wanted to buy an ethanol plant. They borrowed money to do so. However, in the financial crisis, they came to face challenges. First of all, the commodity prices shot up, and therefore the ethanol plant was not profitable. Secondly, the leverage killed them off. So they actually entered bankruptcy after that. Now, as the company was just going through the bankruptcy proceedings, they understood that their legal counsel, also one of the insiders in the company, have been selling stock before he was allowed to, so he was breaching securities laws. And at that point, the company decided, and the SEC also decided to sue the insider for the damages that he done. At that point, when they discovered that, Thomas Brazil, now a fund manager of BU Capital Management and a personal hero of mine in the OTC market, has looked at the stock at that point. So he understood that what is going on, and he understood that there are some bankruptcy proceedings, that there are some lawsuits, and he dug more, right? So again, people that would look at a bankrupt company, they would say, well, why would I even look at a bankrupt company? Well, he just tried to figure out the situation, and what he figured out was that there is a really good investment opportunity. He actually looked at the company when the bankruptcy proceedings were done. So they paid off all the claims, nothing else was left, just a lawsuit. So in effect, the value of the company was just a legal process. And he figured out that the legal process is a pretty good bet, because the legal documents has shown what the insider has done, and that it's pretty obvious that there was the breach of securities laws. So they could win, and of course, if they win the lawsuit, they would be awarded damages, and that damages would be spread over the shareholders of the company because it was still trading on the OTC market. So the equity stub, as one could call it, was still trading on the OTC. That bet paid off. It paid off relatively handsomely. That was 2,000% return on that situation. And I believe what I need to point out is that Thomas Brazil was not a lawyer, and he just figured out the situation. So the research was really the key here that allowed him to do so. And many times, this can be something that could shy away. It could push some people to shy away from the market. Obviously, FNX is a one-off, and probably there are not going to be any other stocks like that, or at least not in the next year, or you're not going to find one in the next year easily. However, it serves as a very good point that I wanted to make, and I really like his quote about the truly undervalued securities. So the fact that it's in the busted, the complex, and the convoluted sector of the market. So that's what really defines, I think, to an extent, some of the opportunities in the market. Now, the second factor, again, not that hard to understand. I think that some people might shy away, but a lot of people would still say, well, okay, I understand the point. I will try to figure out the situation. I'm going to persevere. So now you have an investor that says, okay, well, I understand the reputation. I don't care about that. I don't care about the obscurity because I'm going to figure out the situation, and I'm going to look at the investment opportunities. Right, I'm going to continue figuring out the data, figuring out the stocks. They then some of them come to a third argument. Why not to dig in further? And that's really basically data connected to data. There are perhaps three main arguments that are connected to this factor. The first and foremost, and the most important one, is fragmentation of the market. So as I mentioned, the transparency visibility is hard because the way they are listed on the OTCMarkets.com website. There's not much fundamental data. There can be faulty data. That's outstanding shares are relatively, often they're wrong. And there is vast amount of stocks, a vast amount of meaningless stocks, and there are no screeners. So the fact that the fundamental data points are hard to come by means that you cannot really automate the search. There are some screeners that automate part of it. So for example, if the company is filing with the SEC, that could be potentially automated to a degree. However, there are still some issues with that. But the rest of the market, and obviously where the opportunities are, it's impossible to automate. Now that's extremely unappealing, because what it means is that you have to go through the 17,000 stocks one by one. That's a called A to Z strategy, which is the best strategy to have in the OTC market. I mean, if you don't want to miss out on any opportunity, you have to do so. There are ways to go around A to Z, but they're not really efficient, and you're going to miss out on some stocks. Now, obviously, that means that you have to sit down and just spend some hours looking at the market and looking at stocks, trying to figure out whether they post public financials or what the financials say, what the company does, and how that could create an investment opportunity in the stock. That might seem almost impossible, but it is not. Obviously, it is hard, but I would say that opportunities like FNX or others people are able to find these. I also believe that this fragmentation actually creates a unique discovery process. So on the listed side, you can use screeners, right? It's very easy. I want to look at a company that's trading below tangible book. Bam, there you have it. In the OTC market, you cannot do that, and therefore, if you find a meaningful stock, you are actually setting up yourself for an investment opportunity just by doing that, right? So if you know about a stock, you're halfway there, because if the OTC stock is meaningful and it's trading at an interesting valuation, it's investment opportunity on its own, because not many people know about it probably, right? So it is about that discovery process that create these opportunities and actually create an interesting way to understand the market. However, of course, this is a huge challenge. It is tedious and laborsome to actually go through the stock. So that's where my database comes in, because I'm trying to offer at least partial solution to the challenge. So what I'm working on is a database where I input meaningful OTC stocks, right? So there's currently over 300 of them there, and that should allow the screening process to an extent. And that should allow investors not to miss out on the OTC opportunities. The stocks are not inputted just via ticker. I input some basic fundamental data and commentary. I'm going to show you that a bit later on. But what it really ties down to is really idea generation, right? So it's not only screening the market, but it is really about finding the next OTC gem in that database and trying to figure out what the stock's doing. And I believe that this database is actually the only such database in the world currently available. And it aspires to be Volcker's Manual 2.0. So Volcker's Manual was a great book written in the 90s and early 2000s. There are some different editions. And in essence, this was the database. So they wrote about interesting OTC stocks with some fundamental data points. And if you had that in 90s and early 2000, you had some very nice performance. So still, the residual value actually in Volcker's Manual is still very much tangible. And I believe that that's one of the points as well, that the database has lasting value. It's not about the fact that the OTC stock will go up and then you can forget about it. There are some factors that force the stock to trade up or down, and it's important to just know where it's trading and what the stock story was before, and so on and so forth. So that really that's what I'm really trying to work on. So just for you to better understand what the database is about and how it actually looks, here is a showcase of it. So relatively simple Excel spreadsheet for now. And what we're looking at here is the sheet of weekly editions. So in essence, I'm adding 10 meaningful stocks each week, and I input that into the spreadsheet. Now, the reason for one of the stocks data to be visible is the fact that IHRC was actually acquired, so there's no reason for me to hide the ticker. So what I'm adding there is fairly obvious. I add some of the fundamental data points, as I mentioned, but I start with the reporting, the performance. I describe the business in a simple way, and I also talk about what could be the potential value of the company. So if it's trading below tangible book, that's tangible book. If it's operations or dividends or legal opportunity, and so on and so forth. And then we really move on to the fundamental data points. So that's tied to mainly tangible book and free cash flow. I believe these are the two most important data points, really. And obviously, there are some sort of assumptions connected to that. So a tangible book, sometimes you have to argue about whether something is tangible or not, whether you should put it inside or not. But if there is any sort of assumption there, I add a comment, and you can also see how I actually calculate the tangible book. So there's the actual calculation. So you would know if you were to look at the balance sheet what I deduct from that item. I also look at free cash flow. Again, quite subjective sometimes. I would stick with cash flow from operations and then deduct capex. However, sometimes I might deduct some more. Again, if that's the case, then I would add a comment. Outstanding shares, again, very quite important to have that right. As I said, the OTCmarkets.com do not sometimes have the right data there. I also add next report, so essentially when the stock is reporting next. A lot of times that's not available, but a lot of times that can be very helpful if you're tracking the stocks to know where exactly they're publishing and what to look for there. Then I have the column of latest comments, so that's actually the links for my research about the companies. So you can see that there are various names for it: monthly performances, a Sunday update, and issue numbers. I'm going to talk a bit more about it later on. But what it really is that it allows you to just click on the link and then go through the PDF or whatever it is to the research report, which talks about the company, and that is the latest comment, so that you have the most up-to-date view on the stock. If you actually hover over it, you can see that there's a comment. So I add a snippet over the latest comment, so you can see what the stock is about. So if you're looking for it in the spreadsheet, you can kind of get a hint. Obviously, there are some master sheets in the spreadsheet, so you can pile all this together and you can do some preliminary screening with that as well. Now you can see that there's also a line by its own, and it's labeled Bi-Weekly Newsletter. So that would be a stock that I've highlighted in one of the in-depth reports that I'm talking about, so that one can understand, okay, these are the companies that I've covered fully and in depth. And again, you could see all the latest comments there in the same fundamental data. So just to show where the research would be, so if you were to click on the issue number 7, for example, with HRC, you would go through a Slack platform where the PDF is hosted, and you would just download that PDF and read the section relevant to the stock that you're interested in. There's also an email alternative that I'm running, so if you don't necessarily want to use Slack, there's no need for that. But that's how I store it. And just to kind of cover a bit more of the content, I've mentioned that there are different reports that I'm writing on a monthly basis. So the actual monthly schedule looks as the following. The added stocks, as I said, 10 stocks per week, which should be potential investment opportunities. So in effect, I add 40 stocks or so a month. I also write what is called a Sunday update, so that's every week. And the Sunday update actually highlights some of the added stocks and also covers any either sharp moves in some of the stocks that I've looked at before, or covers updates or whether the company reported. So sometimes there can be some of the information there as well. And then the core report of the newsletter are bi-weekly. So first week is one long idea. So I really dig into the stock and present a complete investment thesis of a stock that I believe is a good opportunity. On the week 3, I present 3 long ideas, and some of the research questions might still be unanswered. I believe that maybe perhaps I've done 95%. I'm quite certain that this is an opportunity. However, there are some outstanding research questions that people might have about it. So it's kind of a balance between those two. And then obviously on a monthly basis, I also look back on all the stocks, their performance. Again, I add any updates or earnings. So for example, March is going to be a madness for me because of all the new annual reports that are going to come out. So monthly performance is going to be just full of them. So that's how I actually structure the content and the database and how that interacts together. But let's get back to the factor about data. As I mentioned, there are 2 other arguments that I usually hear. So the first is, can I rely on the data? So if I find the data, okay, I find an interesting stock and I find the data, how is it reliable? Again, I believe that always ties to research. I mean, there's no way you can look at a stock and not be certain about the financials or the numbers. So that's that. But also 50% of the stocks in my database file with the SEC. And by filing with the SEC, you're exposing yourself to further scrutiny and you are exposing yourself to extra responsibility. So the compliance should be there. Therefore, the reliability should be there as well. The other 30% of stocks either publish data on otcmarkets.com, as I mentioned previously, or on their websites. That might, again, raise the issue of reliability. However, only 2 of the stocks in the database, that's 0.5%, do not have audited financials. So there are legal, there's a legal letter alongside the financials, so there is some sort of responsibility. However, they are not audited, which of course raises some sort of red flags, and you need to understand that. However, the majority of stocks have audited financials. So you can look at the auditor, you can understand their history, you can see if the past is somewhat sketchy, or if there are any hints that there could be some potential problem with the reliance. However, from my experience, I have not seen a stock that would be forced to restate in a large way that would completely dilute the value of the company. I believe that what actually happens here is that a lot of people say, okay, well, the reliability is probably sketchy. What sometimes they mean by that is the disclosure actually is limited, right? And that forces them to say, well, I'm not really relying on the data because they're not showing much. And that can be very true. I mean, sometimes the disclosure is limited, especially if they are publishing their own financials. They don't have to comment on them. Sometimes it is really just the financials of the company and nothing else. And even if it is filing with SEC, the commentary can be to an extent limited. However, I would not say that really is a problem with regards to the reliability. I believe that that could actually be an opportunity, the limited disclosure. And from the fact that, first of all, you can reach out to the management teams. So the OTC market and the OTC companies are open, for shareholders or even not people that just are interested in the stock to actually reach out to the CEO and say, hey, I've been looking at your stock, and can you help me with these questions? And sometimes they allow you to actually expand that disclosure through this conversation. And secondly, sometimes the limited disclosure can be an opportunity. So I've looked at a stock probably a month ago that has royalty interest assets. So they generate royalties from their investments. Now the fact remains that they hold some of these assets at zero value on the balance sheet, right? I spotted that through actually looking at the cash flow picture. So they don't talk about it in the disclosure or in the commentary section. But if you look at the cash flow section, you would see that they're selling some of these assets. So on a routine basis, they're selling some of these royalty-bearing assets, and they're selling it for huge gains. So you would have, let's say an asset that you sell for $1 million, and in cash flow from operations, you would have that item at $1 million, so you would have a gain of $1 million, and then you would look at cash from investing, and they would sell it for $1 million, which means that they are selling it for a book value of 0, right? That would be the profit there. So that actually means that the company's balance sheet is really not effective way to look at the company, because there are these assets that are carried at 0, and the reason for that is really over depreciations or the way they depreciate the assets. So there are many reasons for that. But what remains to be true is that the limited disclosure actually presents an opportunity, because again, some people might not catch that. And therefore, there could be an investment opportunity here. And again, you can reach out to the management to try to understand this a bit further. However, I have not talked about the leftover 20%. So I said 50% file with the SEC, 30% either publish on OTC markets or on their website, and what is left is 20% of the stocks in the database. So that's what I would call dark companies, and these companies do not file any public financials. That ties in with the 300 shareholders of record. So as I said, you can deregister if you have less than 300 shareholders, which releases you of the obligation to actually file any public financials. So what it means is that the shareholders of the companies actually know about the investment opportunity themselves. So no one else can actually know if you don't have the financials, right? So that's a really an intriguing part of the OTC market. I think it's one of the most promising opportunities, certainly. Albeit it could be that it's a bit more illiquid, but the point remains that many of the interesting investment opportunities came from this sector. You can tackle that problem through one share strategy, so you can just buy one share, then request the financials, because obviously if you are a shareholder, you're allowed to see the financials. But it really, again, ties back to the obscurity factor. Only the investors that actually own the stock know about it. So that's just, I think, in my view, a great example of the obscurity again. And certainly my database is a collection of direct financials that is growing. So obviously I look at the space, and I want to look at the space very diligently. I want to provide an example of a dark company, and that's Vulcan, and I would call that a dark company, because not only that they don't file any public financials, they actually require you to sign a non-disclosure agreement when you ask for them. So you buy a stock, you buy the share, and then you actually have to sign an agreement that says you cannot share the financials with anyone. You're not going to say anything. So it really limits the amount of people that know about the opportunity again severely. However, of course, it is very important to ask, well, why is there an agreement in the first place? Are they hiding a meaningless business model, or are they hiding meaningless loss-making assets? Probably not. So obviously people are more interested in the stock, and actually Nate Tobik wrote about it in 2014 or 15, and he shared some of the public information that was out there. I think there was a shareholder that sued the management through the lawsuit. There were some things that came to the public eye, and people actually understood that that's a pretty valuable company, especially when it's paying dividends. So the D on the chart means that they're paying out dividends. So actually, you buy that, and you know something about it again. And as you can see, I mean, the stock was trading up pretty nicely over the past few years. So that's an example of an extreme version of dark company. So when people ask about the reliability of data or missing data, I don't think that's I don't think that's a risk at all. I think it can be a potential challenge, but again, it's not inherently impossible to find the information out. So I think it's relatively straightforward that way. So now I've finished the qualitative factors. So I've talked about reputation and how that shapes the market. I've talked about obscurity and how that really forces people to go outside of the market again, and the data arguments where people might not actually be interested in looking further because they cannot find the data, or they don't believe in the reliance or reliability of the data. I want to push some of the points a bit further, and I want to provide anecdotal evidence for the factors. Now, of course, a careful listener would say that that's an obvious confirmation bias, but as I said, I am going to share quantitative data afterwards to prevent the confirmation bias. So I'm going to start with probably the most important types of opportunities that I see in the market, and that's forgotten businesses. Simply put, stocks that no one knows about, or that a limited amount of people know about. Gainsco is a great example of that. So this is a car insurance company that has a great management, and that has restructured the operations of the company and started churning out cash in around 2010 or 11. And they've been doing so and actually grew in the past few years. So from a fundamental perspective, it was a stock that was very strong in terms of cash flow, and it was trading below tangible book for a long time, right? So they were routinely generating 10 to 15 million in cash flow from operations, yet they were not trading above tangible book. I mean, that is really the definition of undervaluation, if anything else, because you have both the cash flow and the tangible book discount. However, of course, it's easy to say that. I mean, it's easy to say that in the past, it was obvious that it was undervalued, and it was obvious that it's going to go up. However, that's how the OTC market sometimes works. I mean, when I stumbled upon Gainsco, I think that was in the middle of 2017 or a bit later than that, October. It was still trading at a pretty attractive valuation, and I then proceeded to talk to some investors about the stock, and some of them were investors that are looking at the market for a long time. And there was particularly one person that really looks at the market for 10, 20 years, and he did not know about Gainsco, right? So he did not know about the stock, which struck me as really interesting, because this was a company that was fundamentally very strong, and it was quite clear that there was an opportunity here, yet he didn't know about it. And I think that really confirms the value of the database, because it shows that you can easily miss out on stocks. This was not something that everybody would know about, and that's just because the data challenges are there, and other places that really they really make it harder to keep up with the market. So I think that's one of the key opportunities, really, businesses that are just forgotten by people. I would also point out that the volume was material in Gainsco, right? So this was not necessarily a stock that would be wildly illiquid and that would be trading on wild swings, right? And moreover, you can see that they again pay dividends. And I still believe it's quite an interesting opportunity. You can read more about that in the Seeking Alpha article that I point below. Another type of opportunity, and that's, I think I would call a cousin of the forgotten businesses, are family-owned businesses or businesses with a controlling shareholder that are not forgotten by people. They probably know about them. However, they found them too boring to actually just invest. And then ties into the catalyst point that I was making in the beginning. A lot of these family-owned businesses are operating relatively straightforward business models. They're doing the same thing all over again. They're not really trying anything new. They're not growing that much, and therefore there's no clear catalyst that would unlock the value of the company, right? So people will look at it. They say, "Hey, well, that's quite interesting, but I just don't see the catalyst, so I'm just not gonna invest." And I believe that that's of course a fair assumption, but it can lead to you can miss out on some very interesting companies. The example that I'm showing here is Candied Fruit, the producer that I already mentioned. It's Paradise Incorporated. I mean, this company is epitome of boring. I mean, they have zero growth in their revenue. So, I mean, zero. They have been generating the same amount of revenue 10 or 20 years ago as they do now. Incredibly enough, the financial crisis, well, not really incredibly, but the financial crisis actually didn't affect their revenue, which is not really a surprise. I mean, Candied Fruit does get sold during the Christmas as always, so you have that cash flow, and they are actually profitable. So they've been able to just carry on and create a little bit of value over the past several years. That helped them because the main helping point was really that they have a near monopoly on candied fruit in the U.S. So you can actually buy a monopolistic business. They have over 80% of the market share. So I don't think they are going anywhere. And until now, the catalyst was not clear. So it was again that really family-owned business that never really had a clear catalyst, although it was trading below NCAV. I mean, net current asset value. So when I looked at it for the first time, it was trading way below. So, the undervaluation was there, but probably people didn't want to invest because they just said, okay, well, there's not going to be any catalyst. However, as you can see in the share price spike in October of this year, the catalyst partially transpired. So the catalyst was that they announced that they are looking for strategic alternatives for the business. Hopefully that means that they're going to sell the business, because I believe that is the best way for them to go forward. We will see if that is going to eventually happen. However, it really drives down the point further that the catalyst sometimes can come when you're not expecting it at all. There were many other examples of that. So JLMC recently had a really nice annual report which forced the shares to trade up. JLMC is a bridal wear company, right, with a controlling shareholder. So, I mean, again, very stable, boring business, but nonetheless, the catalyst, was there at the end. IHRC, which I mentioned in the database, that was one of these companies as well. This was a family-owned business, a life insurer, and they were acquired at the end. And the premium that they acquired it for, in terms of the market price, was roughly 140%. So even if you hold it for 2, 3, 4 years, the average return that you make over that past whatever amount of years that you hold it can still be very meaningful. So while of course it's a fallacy to say, okay, well, you made 140% in one day. Well, you have to look at the long-term period, but still, even then, I think that really drives the value of the opportunities. Another type is information arbitrage. So that's actually quite funny to mention when the technology has advanced so far that we have AI-driven trading, and that arbitrage really in the real world or the listed market is something that people chase on a daily basis, and that is not very visible anymore. And especially information arbitrage, where the market actually knows something, or should know about something, but the stock is not reflecting it. But this is the story of Gunter International. So This company is in the mail inserting business, so they have machines for direct mail campaigns, whereby the machine would insert the campaign inside a letter, and then you would just have the direct mail campaign prepared. You can send it off. They also have another subsidiary which is dealing with ink related to printing and to the mail inserting business. Now, where was the information arbitrage? So if you see the first spike in early October, this spike was due to an announcement that they are preparing to sell one of the subsidiaries. So they were selling actually the mail inserting subsidiary to a third party. The stock obviously doubled, right, because it was good news. I mean, that meant that they're going to unlock some value of the business and so on and so forth. However, the stock then traded lower, right after the announcement, just a few days, or a month ago, a month from the announcement, the stock price was at the same level, almost at the same level as it was before. And that's when you actually could buy the stock, right? So you could buy the stock knowing that they're going to sell and improve the operations. And you could also know that even if they don't sell the stock, don't sell the subsidiary for some unknown reason, or they sell it for a really low amount, you can still perhaps conquer positive performance, but most importantly, you were not really exposed to downside risk at that point, right? So that's one of the more important points. So that was that arbitrage opportunity right there. And actually, when they announced that they actually sold the subsidiary already at the end of December, the stock doubled again, and you could trade in and out of that. So you could buy a stock that had extremely clear upside value, and the downside was relatively low. So I think that these kind of opportunities are there as well. Obviously, the volume was less material in some other places. Obviously, this was a smaller opportunity. However, it remains important to understand that these are really occurring in the OTC market. Another type of opportunities are tied to specific entities. So I've already talked about legal entities, bankruptcy stocks, and so on and so forth. Right now, I want to point out a music trust. So that's Miller's Music Trust, MMTRS. They actually own rights to songs from the 1920s and 1940s. So that's like jazz and swing, and they collect royalties whenever someone purchases the right to play the song. So that makes them a dividend yielder. So they pay out the payout royalties as they go. The amazing thing about them is that despite them being in the 21st century and the state of the radio and music industry that is right now, they still are able to generate a meaningful royalty stream, and that means meaningful dividend yield. I mean, this stock in late 90s and early 2000s. I mean, this was a killer. This had dividend yield of 20-30% at some points. So that meant that you are going to get back your initial investment in 2-3 years, and you were granted that because the royalty stream was really strong, right? And it still is to an extent. I believe that still it's an interesting opportunity, and I expect that they could yield potentially 9% yield per annum in the next 10 years. Just because of the strength of the royalties. So be sure to read the article. I mean, this is obviously a long-term forecast, but the royalties really do seem quite well defended from that. And again, of course, you can see that on a quarterly basis, you're going to receive some dividends. Actually, the stock also appreciated, so there's some capital appreciation as well. But that's obviously sometimes a bit risk with the dividend yielder because it would dampen the yield. But that's again another very specific entity that is out there. And I would also point again that I was talking about one guy who's looking into preferred stocks in the OTC space for a long time, and so he's looking for dividend yielders. And while MMTRS is not a dividend yielder, it is not a preferred stock. He did not know about it. Right, so I think again, it can slip through the cracks. Each stock, and investors can miss out on, and then of course it cost them the opportunity. Because I know about an investor that was invested from at least the 90s, and obviously, I mean, he enjoyed the dividend yield, to say the least. The last opportunity that I'm going to talk about really quickly is just NOL entities. I mean, there are many other opportunities out there that I haven't mentioned. Community banks, insurance companies sometimes can be interesting. Local community communication providers, and others, that can be really interesting. So there's a lot of other niches that I'm not going to cover here, but the one that I find quite interesting is our NOL entities. So this would be a company that probably sold the business and now just hold a large portion of net operating losses, which they can utilize as tax relief. So usually they try to get a business inside the entity, and then they can write off the NOL asset. These opportunities are interesting because they're clear catalysts. So either the management is going to buy you out and they're going to utilize the NOLs themselves. So for example, Steel Partners, SPLP, sort of like a traded hedge fund, has been doing a lot of work in these NOL entities. They've been buying them out. Or the management themselves, they want to unlock the NOL while you retain the ownership. That's slightly trickier. Sometimes dilution is involved, but there are really interesting opportunities. And the one that I've highlighted here is Western Metals, relatively small entity, trading below cash, trading below NOL levels, and with a management that probably is capable of unlocking them in an interesting way. So that's one thing to remember. Arquitos Capital, I think, have been active in this space, exploiting the opportunities in the past as well. They've been writing for Seeking Alpha, I think, for a while. So that's there's that as well that you can check out if you're more interested in that. However, I think that was really enough of examples to really drive down some of the obscurity points, data problems, or specific entities, and so on and so forth, that really drive the opportunities in the market, how they connect. So now it's time to really look into the data and see whether the qualitative factors hold up. I scrutinize the performance on a quarterly basis on Seeking Alpha, so I publicly showcase the data set, of course, without the tickers being there. And if anyone is interested in my public performance of the stocks, it's either on my website or on Seeking Alpha, so go check that out. And the performance that I'm going to talk about is February performance. So that was the last quarterly performance that I did. And in that quarterly performance, the data set showed that the investment thesis holds, that OTC is space where you have valid investment opportunities. The main assertion is here that this is due to the fact that more than double the amount of stocks went up 20% rather than down. So in absolute values, this was 67 stocks, went up more than 20% since addition to the watch list. And I argue that a material amount of these were meaningful companies with meaningful volumes, and that the catalysts that drove the share price to actually trade up were quite clear, and they were connected to the fundamental data point, right? So they were connected to the fundamentals. So if the company is operating, is churning out cash, and they continue to churn out cash, the share price is going to go up, and you can participate in it. Conversely, the stocks that went down, I argue that they were largely illiquid securities, so they're subject to wild swings that are not necessarily connected to fundamental perspective of the company, or they were binary investment thesis. So these could be investment thesis that where the stock has to survive in order for you to see a return. If it doesn't, then obviously there's going to be underperformance. So this risk reward scenario is something that one needs to be aware of, and certainly there are investment opportunities in this space as well. However, due to the fact that they are binary, it can run largely against you. So I would not say that a lot of the stocks that went down are stocks that would be meaningful with meaningful volume, and that the OTC market somehow is ignoring the value. I mean, this performance really runs contrary to the academic papers from SEC and others. I've mentioned the papers in the beginning of the reputation, so I sourced them as well. I sourced the most important one. It's a white paper from SEC called Outcomes of OTC Investing. That's kind of a good way to actually get an understanding of the academic point of view on OTC. And these academic papers obviously objectively and statistically look at the market and say that the stocks underperform, and not only the listed market, but they underperform the absolute value, therefore they lose value. However, there's one big problem with that, and that is that the academic papers are objective, and you cannot be objective in the OTC market, because if you are objective and you essentially have your data set comprised of companies that you can only sort through reporting or through volume or through other non-fundamental data points, then you can really pile the whole group together. And as I said, only a fraction of the companies out there are meaningful. So what the academic papers are doing is that they cannot differ between the stocks, which again is right. I mean, it's the right way to do statistical analysis. However, it does not reflect the market well, because it piles all the stocks together. So I'm subjective when I choose the stocks, right? I try to be as objective as possible. However, I understand that my assertion that a company that's trading below tangible book and that has this kind of business model, is meaningful. That's my subjective view. So that's why I believe there is the difference. And obviously, I mean, the arguments that the academic papers present are really just strengthening the qualitative factors. I mean, the SEC talks about manipulation and pump and dump schemes as a result of the performance. So, they say, okay, well, the performance is bad because of that. The other academic papers are a bit interesting in the way they word the results, because they don't necessarily want to mention pump and dump or manipulation. So they try to say that there is some sort of disagreement of investors around OTC stocks, which I think is quite intriguing, because if you don't mention manipulation or pump and dump when you look at objectively on this OTC market, I mean that's an intriguing way to look at it. But anyways, the academic papers have one problem, that's objectivity, and certainly that's the right way to look at the market as a whole. But I believe that that's why the difference in performance. So just to look at the actual data that I presented on the quarterly in the quarterly report. Again, you can see that on Seeking Alpha. So these are the stocks that went up more than 20%. Unfortunately, the list is a bit long, so to ensure readability, I had to actually cut it off at 45%. What I want to point out here is that the stocks that are up have meaningful volume. What I call meaningful volume is more than 50,000 in volume in the past 30 days. For some, that might seem very small. We're going to touch upon the volume later on as well, but in effect, what I want to show is that there are not that many stocks that really had zero volume and that had non-existent volume. Right? There were stocks that had more than 100,000, more than 1 million in traded, and they were trading up. So that allows the investor to catch the opportunity. On the other hand, of course, what the stocks that went down, and these are all the stocks that went down, look like is I would concur the opposite. So there's less stocks with meaningful volume that went down. As you can see, there are some that have not moved much in terms of volume, and also there are some that are down because it's a liquidation scenario. So that's in this case, in this quarterly database, it's actually 8268. So the stock that has over 1 million in volume and is down 35%. Well, that's due to the fact that they paid out dividends as a portion of liquidation. So that's actually not the performance is not adjusted for dividends. So that's why there are some stocks that are here that really do not make much sense to be down. And again, there are some NOL shells here that are subject to wild swings if there's nothing going on for a long time. So there are many entities that don't necessarily have to be that investment opportunity right now. However, of course, there are stocks that have been down and have been trading with meaningful volume. But again, I assert that I believe that a lot of these are due to binary investment thesis, where you have balance sheet risk or leverage risk, which really makes it harder, or which really makes it important to understand the risk-reward scenario. So that's the quantity data. So now let's turn on to the risk factors, right? So I covered the qualitative factors. I backed it up with quantitative data. So the bullish points are holding up so far. Now the risk factors and limitations of the market are important to understand. I think that the first real risk that one needs to really understand is to understand that there could be a factor of bad corporate governance in the OTC market. And what I mean by that is just a management that can steal from the minority shareholders, right? It is easy as that, and it's very important to actually ask yourself, can they steal from me? Have they been stealing from minority shareholder in the past? Now, if I mention stealing, it means it could sound a bit extreme, but a lot of times, for example, if there is a controlling shareholder that diverts its salary, has a high salary while the rest of the company is suffering and the cash flow is not there, because of the salaries. That's a pretty detrimental way to run the business, and I would label that as bad corporate governance. So it's very important again to understand that in the research. I would, however, say that it could partially be minimized by learning about the past dealings of the management, right? So there are many examples that you can see and track and say, hey, well, this manager is not really open to discussion with minority shareholders, or they're doing these bad steps that might be a challenge in the future. I've talked about the controlling shareholder that really can do whatever to an extent he wants. There's also lowballing. So quite a common strategy is that the companies that are listed on the central exchange, so on the stock exchange, they would go OTC, and they would go OTC for one reason, that is to take out the company at a discount. Now that can be discount to tangible book, but it can also be discount to the share price that they were trading before, so that to make it cheap, to lowball it. Because what happens when you deregister from the national exchange or you deregister from SEC, a lot of times investors just sell. If there are any institutions, they sell. If there are investors that do not look at the OTC market, they sell. So a lot of times that just really means that the share price is going to be depressed. Now, there can be potential opportunity for the management to buy out the rest. There's some more let's say straightforward or obvious ways to showcase the bad corporate governance. Repricing options, one of the favorites. There are cowboys there where they just say, well, the share price has gone down, so I think it's time for us to reward ourselves with repricing options. There are share offerings that might not make perfect business sense or might dilute the value of the company a lot. So there's quite a few examples that you could use. And it is very important to understand that happens in the OTC market. However, not only that you can partially minimize that through research, you can. It's also not every stock. This is a factor, but it does not affect every stock. Certainly, there are some very good management teams in the OTC space which have minority shareholders in mind. I would also say that you can defend yourself against it. However, that can be tricky and can be challenging. You can minimize the risk, but only some investors can actually do that. Obviously, you can sue the company for breach of fiduciary duty, or the management team for breach of fiduciary duty. But that's I would say very challenging. If, for example, lowballing happens, there is an easier way to defend yourself. You can appraise your rights and essentially sue the company for the acquisition price, and then argue in court for a higher price, and then you might actually receive that. Appraising rights is a very interesting strategy, and it can be very profitable as well. So that's one way to defend yourself as well. And I have to say that, of course, activism is alive in the OTC market. It's not that it would be non-existent. You can ask Jack Gilman and others that have fought activist campaigns in the OTC land and have been successful. So again, I believe that this factor is very important to understand because it's not as frequent on the listed side. However, you can minimize that through some parts, and it's not impacting every stock. So in my view, it doesn't offset many of the bullish points that I've presented. The other point that I want to cover is another notorious factor that investors actually usually raise before. They even raise their reputation, their data, and they would just plainly say, well, I can't trade in the OTC market because there's no volume, right? And that's a very important point to make. Right now, we are when we are in the factor 5, we're talking about such a small amount of investors that look at the market, right? Because we've started with reputation. So some people will leave at the reputation. Some people will leave because the market is too obscure. Some people will leave because they don't believe the data. Some people might leave because they feel that the bad corporate governance is a problem. Now, if we're talking about the leftover amount of people that still look at the market even despite these factors, we are looking at a small number. So of course that means less trading, which can mean liquidity. I would say that on the purchase side, so if you buy the stock and you cannot buy it because of volume, that's not a real problem. It is certainly unappealing to see investment opportunity pass you by, but all you can do is to put up a bid and wait for the best. So I would not call that a real problem. It's a challenge, but again, if you look at the market, I believe that there is a fair amount of opportunities there. Volatility that is tied to liquidity does not have to be an issue a lot of times because it can be tied to non-fundamental factors. So someone can sell the stock at below the market price because they just need to, because they want the liquidity. So actually, if you are providing liquidity in the OTC market, sometimes that's the best position to be in. So a lot of times the volatility doesn't matter that much. If the share price is going to go down 10-20% on a day and nothing has changed with the business, inherently that's not a problem either. But of course, the volatility becomes a problem and the volume becomes a problem when the stock is going down. And I would also mention that before continuing on that path, I would mention that of course limit orders are extremely important, right? That is really tied to the volatility because the share price can jump so high or low. At some points, you need to use limit orders, right? So you have some sort of understanding of where the undervaluation lies, and you can say, okay, well, I'm fine with paying a bit of a premium on the share price because I know that there is still a meaningful upside of left. But it's very important to utilize that. I have a funny experience with limit orders, or not experience myself, but I was following one company maybe roughly 1 or 2 months ago, and this company is, in my view, quite a solid investment opportunity. They're trading below tangible book, and they're generating profit. So it was interesting to look at them. However, one day the company shot up like 50%, and I was like, okay, did I miss something, or have I not scrutinized the company properly, or what happened? And I couldn't find anything. And essentially the next day the share price went back. So what could possibly happen is that someone just entered a market order and did not use the proper limit order, or they entered a limit order that would be too high and they actually got executed on the order. So that can hurt very much if you enter the position and you enter it at the wrong price. That is bad. Of course, on the other hand, someone sold him or her the share, so that is a nice gain on a day where there are no fundamental news. But back to the selling problem. Volatility can be a problem when the thesis goes against you, right? So, and that happens, on a yearly basis, on a monthly basis. Whoever knows how often it happens, but it happens. And once it happens in the OTC space, you can be forced to sell way below your cost basis. You can be forced to actually hold a position even if you don't want to, because there's just no investors that want to buy. So that's one of the most important problems, because you can minimize that through portfolio allocation and strategy. So running a concentrated strategy in OTC space, when you pile into 4 stocks that are illiquid, probably you're not going to minimize volume risk with that. But there are ways to do so. A basket approach, or a certain effective a strategy could prevent you from being exposed too much. However, there is that risk, and it's very important, because the capital loss, again, that I've been talking about at the beginning, is the worst loss that you can have. And because of the volume, it can happen. So it's very, very important that illiquidity can be a real risk. So investors need to be acutely aware of that, right? And again, I think that that's where the importance of prior experience comes in. So when you trade on the listed side, usually you can sell after the stock plunges. But what I mean by experience is that you experience the plunge and you say, okay, well, am I going to stick with the stock or not? And these kind of experiences can then help, because the listed market has more volume. So if you decide to do whatever, you are able to execute that. On the OTC market, you might want to sell, but you cannot. So that's I think a very important point. Again, I believe that sale problem can be minimized to an extent, and in my view, again, even with the board, with the corporate governance, I don't think that it offsets the bullish points, because as I've shown the amount of stocks that have meaningful volume, that have been going up or down, is there. So it's not that there would be stocks without volume everywhere. I think there are stocks that have meaningful volume. So these were the risks. These were the two main risk factors on the OTC market. And I'm going to finish off with the last factor, which is actually neutral, and that's natural barrier. So the volume is an issue, obviously, for larger portfolios, and I don't mean by that the portfolio would not be able to sell at the right price or whatever, but it's really just hard, even in the first place, to accumulate the price, right, to the shares. Because you're moving the price. If you're the only buyer there and you're a big buyer, it can be really detrimental to the accumulation process. So this is an estimate, but probably a portfolio of about 10, 20 million could be the limit that you could employ in the OTC space. You could probably employ more if you want to be active shareholder. You can employ more in special situations and special opportunities. But in a regular type of portfolio that could be 10 to 15 stocks. I mean, you were pushing it with the 20 million there, I would say. But of course, I mean that depends on their strategy. However, that's for OTC investors, that's nothing to do with them. I mean, that doesn't affect the investment thesis. This is an advantage for them because, again, it lowers competition. So again, it lowers the amount of people that are looking at the stock, and therefore you're looking at more at bigger potential to find a meaningful stock. This, of course, means that institutions can't participate as much, right? So mutual funds or hedge funds are not that frequent in the OTC space. However, there are for sure some asset management firms that operate in the OTC. I mean, Alluvial Capital, I mentioned one before as well. So there are investors that do operate in the market and have a partial or whole portfolio in the OTC, but it is rather an exception than a rule. But as I said, this is a neutral factor that OTC investors don't really have to do anything with. It's probably a good problem to be thinking about how to employ a lot more money. So I guess that's why it's really neutral. So now I just want to conclude the presentation and kind of bring all the factors together. I believe, again, as I said, that the space has meaningful, valid investment opportunities inside. I would say that these are present due to the factors that are sometimes perceived as risks. So that would be the reputation. People shy away from the OTC market because they believe that a lot of these stocks are pump and dump. While this may be true, there are certainly meaningful stocks. There's the obscurity part where you have to understand the situation. You have to dig in order to be happy about your situation there, and if you're not willing to do so, then obviously that's a problem. But again, it creates more opportunities. Data problems or challenges are certainly to an extent real, but they are not risks in my mind. And the qualitative factors are supported by the OTC database. So the results of the database show that there are stocks with meaningful volume and clear catalysts that can go up. Obviously, stocks can go down as well. There have been stocks that are meaningful and had maybe a binary investment thesis. However, they were still going. So the database really supported that because, of course, double the amount of stocks went up than rather than down. And there are certain challenges and there are certain risks, such as bad corporate governance that one needs to really understand, or volume, especially when you're about to sell. However, I do not feel that these really offset the upside, and that's mainly because of the quantitative data, right? The qualitative factor is not really, it can be very affected by the risks. However, I show that the actual quantifiable risks are the volume are not as challenging as it might seem. And I believe that I provide solution for one of the biggest challenges out there, and that's idea generation. And essentially, the OTC database allows investors to screen the space, which should alleviate the challenge of idea generation there. And the last thing I would like to mention is that I'm running a special offer for the subscription of the newsletter and the database that will last until the 31st of March. So right now you can buy a 3-month plan for the price of only 2 months. So once you purchase the the subscription, you get instant access to the database and all the past research. And you can do so through my website. You don't need a PayPal account. I use PayPal as the payment gateway, but you don't need that account if you don't want to. And certainly, if you have any sort of feedback, do not hesitate to reach out, especially if you believe that I've missed out on something or I misinterpreted something, be it about the OTC market or my database. Please do reach out. You can do so through email. You can check out my website. I am also on Seeking Alpha and LinkedIn with my names. So that way I'm accessible as well. And with that being said, I hope that you enjoy the presentation, and I thank you for your time and for your patience hanging on with me throughout the presentation. Thank you very much.